Why would you do that to yourself? This is some UK scam. Hi, my name is Shay. Welcome to my channel where I post all things business, property and lifestyle. Now, as someone who owns 6 properties within their current portfolio, I can definitely say I know a thing or two when it comes to interest-only mortgages. Have you ever wondered what are interest-only mortgages and why do landlords find them so attractive? Well, in this video, I'm going to go through exactly what they are, why they're so attractive to landlords, and why when you buy your first property, you should give it some serious consideration. An interest-only mortgage is basically a loan that you get from the lender where all you pay off is the interest and not the actual amount that you borrowed. For example, let's say you borrowed £200,000 from the bank over 25 years. Now, you will still owe £200,000 at the end of 25 years because that's the initial amount that you borrowed. But what you will be paying through that 25 years is the interest on that amount. So you're probably thinking, Shay, this sounds like a scam. Why would you do that? I mean, why would you borrow, money, £200,000, and you still owe £200,000 after 25 years, after paying, like money's leaving your account. It's not like it's not leaving your account. And all you've been paying through that period is interest. The main reason why a lot of landlords use interest-only mortgages to finance their properties is because of your monthly payments. For example, let's go back to that £200,000 that we borrowed over 25 years. And let's say there is an interest rate of 3%. Sorry guys, I had to write this down because I can't be coming up with this and be cutting video. So let's say for, like I said, £200,000 over 25 years at 3%. Now, on an interest-only mortgage, so you're only paying the interest, your monthly payment is going to be £500 a month. Now, let's say you were to do a repayment. Now, a repayment mortgage is basically when you are paying a proportion of the loan that you borrowed, the initial amount that you've borrowed, plus the interest. So you're paying a proportion of both of that per month. And that's why in a repayment mortgage, your initial loan amount reduces over time. The £200,000 over 25 years, 3% interest on a repayment only mortgage, you would be paying about £948 a month. You haven't borrowed more, you haven't borrowed less, the interest rate is not different. Exactly the same circumstance, but interest only, you're paying 500, remortgage, you're paying £948. It's all about the cash flow. What landlords are actually doing is freeing up more cash for them to use for other things, whether it's to fund their lifestyle, to pay, bills, to save up, to buy another property, whatever it is. The idea is you have more money landing in your bank. Sometimes you go into property with, mainly it's 2 strategies. Either you want cash flow or you want capital appreciation. Now, capital appreciation is basically when the property that you've bought increases in value and you take advantage of the increase by using it as profit. So what I mean by that basically is, let's say you buy a property for £100,000, you do up the property, whatever it is you want to do, but it goes up in value. So let's say £150,000. You sell the property, if you take away all the money that you've used to do up the property, let's say you use 20k to do up the property, you've now got 120k in that property, but it's now worth 150k, you sell it off, you've made 30k. That's capital appreciation. It's gone up in value compared to how much you bought it for. Let's say cash flow was your strategy. You've got cash flow by using the interest on your mortgage because you're paying £500 a month. You've got the extra money coming into your account to pay for bills, pay for what is there, what the cash is there to pay for. But then you have that added benefit, because if you've got the asset for a long period of time, you've got the added benefit of potentially capital appreciation. Well, as you know, guys, there are some pros and cons when it comes to things generally in life, and unfortunately, interest-only mortgages don't escape that fact. One of the drawbacks, unfortunately, is that you still owe 100% of the money that you initially borrowed. So let's go back to the example of the £200,000. You borrowed £200,000, it's been 25 years, you still owe £200,000. Another drawback, unfortunately, is that you're going to be relying on the property either maintaining its current value or at least preferably increasing in value. And the reason for that is, imagine, let's say you bought a property for £200,000 and unfortunately, 3 years down the line, it loses its value and it's only worth £180,000. Now, let's say you sell the property to try and pay back that original loan. If you're selling it for £180,000, you're 20k short. So you're still going to owe the bank 20k. And this is why it's very important for you to crunch your numbers. It's not just like, oh, I've got money in the bank, I'm going to go and buy a property because I've got the money and that's it. There is a strategy to it and you need to crunch the right numbers. But there are some details that you need to start looking at, before you even start the journey, to give you the options that should that happen, what is your fallback plan? The third drawback for interest-only mortgages is that you end up paying more interest over a longer period of time. So now you're probably thinking, Shay, what do you expect me to do? How do you expect me to now go and buy my first buy-to-let with all this drawbacks? You know, how can you expect me to borrow something and I don't know how I'm going to pay it off? Shay, what do you expect me to do? Don't panic. Yes, I know it's overwhelming, and yes, you're a little bit scared, but trust me, I've got 6 properties. I wouldn't be doing it and continuing to do it if I didn't think there's ways to mitigate against those drawbacks. So there are ways you can generate the money that you need to be able to pay off the initial loan at the end of the term. You could use an endowment policy, and that's basically a life insurance policy that pays out a lump sum at a specific date or at death. You could use your pension, you could, start saving, or you could use your stocks and shares investment, or simply you could sell the property and actually benefit from some capital appreciation that I spoke about earlier. So how do you decide if an interest-only mortgage is right for you? Well, first of all, you've got to think about your investment objectives. What is it that you're trying to achieve over the long term? Then you've got to think about your tax implications when it comes to the structure, the way in which you're buying the properties. Are you buying it as an individual, or are you buying it as a company? For example, my husband and I use interest-only mortgages because we want to maximize the cash flow that it produces to offset that dependency that we have in our 9 to 5. And we also own our properties as companies rather than individuals because it's more tax efficient for our long-term strategy. Now, with every type of mortgage, there will be pros and there will be cons. There will be advantages, there will be disadvantages. But what you do need to think about is, what are your investment objectives? What are your goals? What are your strategies? Because that's going to help you make the right decision. Now, guys, I hope you found this video very helpful. Don't forget to hit the like button, subscribe, and all that jazz. And I'll see you guys in the next video. Bye.